Is it because you haven't seen the results, you are not clapping for me? You've got to believe in us. This is EABL, guys. Good morning, ladies and gentlemen. Can everybody see me? It's a real pleasure to welcome you to this investor briefing. Obviously, we do this twice a year. The first half of the year, we normally take that about February. Obviously, because our financial year runs from July to June. And then we do clearly the briefing for the full year in August, as we are doing today. I've seen a number of faces that really have encouraged me this morning. It just speaks to the fact that the interests that you investors and shareholders, brokers and analysts and all stakeholders involved in value creation in East Africa and indeed beyond that are really interested in our business. I'd like to say again that that really delights us to no end. We would like to be, to let you know that we're pleased that you still, have the faith in us and the confidence to really come out and listen to us as we share the full year, F11 full year results with you. I'm privileged also to have in our midst today the people that really make this business tick. The executive directors of East African Breweries Ltd. And with your permission, I'll just ask them to stand up and very, very quickly introduce themselves. And then I get into the presentation. So can I ask all of my colleagues on this table to please stand up and just say who you are, just so that our investors and shareholders can get to meet with you.
My name is Baker Magunda. I'm Managing Director for EABL Kenya.
Thank you. So Baker runs our business in the Kenya office, Kenya operations.
Good morning. My name is Peter Ndegwa. I'm the Finance Director.
Thank you.
Good morning. My name is Aristide Kumondo, and I'm the Procurement Director.
Good morning. My name is Joseph Ngile. I'm the General Manager, Central Glass Industries.
Thank you.
Good morning. My name is Mombi Brewery, General Manager, East African Mountains Limited.
Morning, James Karegi, Group Supply Director.
Eunice.
Good morning, Eunice Warrero, Head of Group Business Performance Management.
Good morning, Group Company Secretary, Agnes Norbert.
Thank you, Agnes.
Good morning, my name is Jojo Boni, General Manager, EABL International.
Thank you.
Morning, my name is Brendan Batley. I'm the Group Corporate Relations Director.
Thank you very much. And we've got James Mugo here, who heads strategy, and as well as Stephen Wachera, who is my executive assistant. We are a very diverse organization in terms of management makeup, and so we have quite a number of experts in different functions who are not with us today. Just in the same way as we have a lot of Kenyans and East Africans serving, across the entire, business operations of Diageo globally. So to that extent, we would like to think that we are very well set up in terms of capability within the organization. I'm Nigerian. We've got Kenyans there. We've got Cameroonians. We've got Ghanaian in Jojo, and like I said, we've got some British directors who are not here today. Some traveling, and so we're really pleased with our makeup in that respect. So why we're here today, we want to talk about our F11 performance. But before I get into that, just a reminder, as we have said repeatedly, East African Breweries Limited is all about being the most celebrated business in Eastern Africa. And in fact, I was so delighted when about 3 months ago, we became the most capitalized business on the Nairobi Stock Exchange. In other words, we beat the company that was #1. I shouldn't mention their name, but you know who they are. And so if you take your business daily and you just look at market capitalization across all the businesses in East Africa, as per their stock valuation on the Nairobi Stock Exchange, we are at this moment #1. We are very delighted about that. I read in the Nation newspaper yesterday about some survey that had been done on the value of corporate brands, and in that one we were #2. I wasn't happy. I wasn't smiling. All the people around me knew I wasn't smiling because the game that I play is a game to be number one. So, but that's who we are. Our vision is to be the most celebrated business in Eastern Africa. What does that mean for us? We are intent at being the employer of choice. In other words, creating the best place to be in East Africa. If anybody thinks where's the best place to work in East Africa, it's EABL. And really creating the environment where our employees can sign up as citizens of EABL, meaning that they want to work for EABL for life. That's what we are intent at, being the employer of choice. We also intend at consistently delivering superior total shareholder returns as measured by a combination of the profit that we generate from our business as well as the dividend that we give to our shareholders. And lastly, we are intent at being a force for good, enriching the communities in which we operate, being the benchmark for good corporate governance, and actually being the benchmark for the best control and the highest possible standards of controls and compliance that you'll find in any organization. That is the game that we are playing at East African Breweries Ltd. So in terms of how the business has performed in F11, a bit around the macroeconomic environment and the political environment, and who am I to speak to this group of people? A lot of you are so much into this that the information that we share, we actually get fed from you. But as managers of a business, you would expect that we are very close to what's happening within our environment. From a macroeconomic standpoint, F11 had been actually a very challenging year. It was that kind of year where you almost talk about a yo-yo environment. At one hand, you've seen some positive signs of recovery from the 2008 downturn, and just as you begin to think it's time to celebrate, you start getting other shocks in the economy that speak to the fact that actually we have not fully, and we meaning the world, Africa, sub-Saharan Africa, everywhere, have not fully recovered from the impact of 2008. That's the way I see that. A bit of, like I said, some positive signs, but ultimately, if you look at where we're coming from several years ago, we would not say that we're there right now. Things have been obviously, made even much more challenging as a result of some of the political unrest that we saw across North Africa and the Arab world early in the year. And in fact, we still know what's still going on in Libya. And what's the import of that? It's all around the impact that has on oil availability, oil pricing, and all of that. Clearly, for us as a big player in the manufacturing environment or industry, that has had a significant impact on our operations. Then add to that some of the challenges that are coming through from the Eurozone weaker economies, your Greece, your Spain, and some of those markets. And the point about that is that while we continue to say that Africa is very resilient, we are indeed, but we don't always have to balance that by the fact that we are not at all insulated from what is happening around us, and because we don't operate in an isolation. Okay, we're not operating an island as a business or as a continent. So on the positive side, we get encouraged by the fact that GDP growth in our part of the world are still by far the most encouraging, and depending on when you measure and what your reference is, it could be anywhere from 4 to 6% across East Africa. I think that's absolutely encouraging. In the Western world, people talk about 1% growth, they talk about minus 1% growth. So I think that's really positive. I think it's positive to see some of the work that's going on across the patch, across the region, in terms of infrastructure development. And in fact, you look at the road construction that is happening here in Kenya, it can only lead to positive economic outcomes. And not least the fact that there will be those I call the blue-collar urban adults who obviously will get employed as a result of some of this construction work going on, new money is being injected into the economy and all of that. So all that is positive, especially for us in the context of the business that we do. Also, we've talked a lot about the FDI's foreign direct investment, investor confidence, and I always joke when I talk with my colleagues in DIGO when I say that investor confidence is increasing in sub-Saharan Africa. And I always say to them that it's not so much about the ingenuity of what we are producing in sub-Saharan Africa, but it's actually partly because people are running away from the economies that are collapsing anyway. And when you are running away and you got this pot of cash, you want to put it somewhere. The somewhere where they're putting it, as far as I know now, is in sub-Saharan Africa. I cannot tell you how many calls I get about investors just wanting to talk to us, know what we are doing, just get a bit of confidence that would encourage them to invest in our business. So it's really encouraging that on the positive side that we belong to this part of the world at this point in time. I cannot say enough of that. And I think on the political front, the fact that we, irrespective of the challenges that we had after the elections in Tanzania, last year, in Uganda and all of that, I think the reality is that, our world here is still pretty quiet. And, yes, there are some elections coming through, but again, we have to recognize that the world is not perfect, and to that extent, on the political front, I would like to think that we've had a reasonably stable year. I'm particularly pleased that one of our key markets, both for today and in terms of our strategic outlook for East Africa, Southern Sudan, obviously has gotten independence. We were very delighted about that, and in fact, my joy knew no bounds when the government of Kenya wanted to send a team to go and play against the Southern Sudan national team on the day of the celebration of the independence, and they called us to find out if we could send Tusker FC to represent Kenya. Of course, we gladly did that, and our Tusker FC thrashed the Southern Sudanese national team by 3-1. But that's what we bring to the party as EABL. We're so much to this community, and we see ourselves as being very Kenyan as much as we are East African, as much as we belong to the DIG world. So it's really about getting the balance, leveraging all of this to our good, and that's who we are. On the negative side, I've said a lot about the global economy and the impact of that. Like I said, the Eurozone weak economies and all of the impact of that. But I think coming home, the challenges that we've had with things like droughts and lack of rains and the cost of fuel and food and all of that, clearly, without a doubt, have impacted on the economy, and to that extent, impacted somehow on our business. The other thing that I need to point out is that we are also excited about the EAC. We have cause to be, but our position is that we're not getting enough traction on that agenda, because if you look at what the EAC could actually bring to the economies in East Africa, and if you took the position that if that was fast-tracked and things were working just in terms of, breaking barriers and really getting, shape products, services, people working across, duties harmonized, etc., the impact of that on the economies of East Africa could be huge, something beyond what you and I can imagine. But that traction is not coming through as we would like to on the negative side. The last one I'll point out is that a lot of people have talked about, and I'll talk a little more about it. Maybe I'll take it the next one. I'll thinking about the regulation thing, because I'm beginning to think that we're going from the normal regulation to what I call over-regulation. Okay, and actually that takes me to the next slide when I talk about the other challenges that business has faced. The whole thing about the Alcohol Drinks Control Act, we've talked about severally, and we've mentioned the fact that clearly as an organization at EABL, we signed up for the intent and the spirit of that. I remember the half-year investor meeting, I think it was in this same room, I said exactly that. However, some of the flaws that we saw with that act, at the time we had that investor briefing back in February, are still very relevant today, and I think I would suggest even more so. Okay, these are things that we have predicted. I would like to think that the stakeholders within government are increasingly saying that some of the things that we're saying are absolutely correct. The first thing that I would recall is that, and I said that at this investor meeting last February, that we did not feel engaged sufficiently in the production of that act, much as we would absolutely have signed up that is the right thing to do, because the intent was to protect legitimate business. And therefore, why would we not, given our own very stringent rules and policies around, our marketing codes and all that? However, we're not sufficiently consulted on that. Secondly, we do know that there are, clauses in that act that are, just impracticable. They're just not unreal in terms of the implementation. And then thirdly, we did not believe then, I do not believe now, that the administrative apparatus to implement that to the letter of the word of the act in a way that would ensure that there's a level playing field, that would ensure that illegitimate and illicit brews were not advantaged. We always said that that administrative apparatus was not there. It is not there today. Therefore, what we are seeing in that respect, contrary to what was intended, is actually a very significant, really material growth of illicit and illicit brews in this market. A lot of underground consumption taking place, and it saddens me to know that clearly we do know that the government of Kenya actually intends to address the subject of illicit and all that. So when you see us as EABL making a case for that act being reviewed and all that, we want to absolutely suggest that actually it's in the context of ensuring that the consumers in Kenya are protected in the way that the act was intended to do. Okay? But this part of the Alcohol Act in Kenya here, and to some extent, the ban of sachet in Uganda, and some of you who are close to Uganda will know that one of the biggest brands, especially certainly in the spirits category, is Uganda Waraji. Okay? Uganda Waraji for us was to a large extent in sachet, and the government has banned sachet now. The problem is that because we are who we are as EABL, as Diageo, we are bound to comply with all government laws and policies. So we've had to withdraw from sachet in Uganda, and they converted our brands that were in sachet into PET. Obviously, that comes at a higher cost. But the reality is that you go into the market today, you find a lot of other brands that are still in sachet. All we are saying, that I'm standing here to say in front of media and everyone, is that, much as we're a big player in this economy, and we are, one of the largest taxpayers, we are very compliant. We need the government to protect our business. Let one rule serve for all people. If it's if we're now, for instance, saying that we are legitimizing the sale of traditional liquor in Kenya, but that they have to go by the registration and the marketing codes and manufacturing codes, let somebody go out and ensure that they are doing that before selling the products, is all that we're saying. We've also had our fair share of excise taxation increases across in the year, and that is in spite of the fact that, like I said before, the disposable income of the consumer is actually declining as a result of the challenges around food and fuel and all of that. Competition in Uganda, Tanzania, Southern Sudan has since increased. I always joke with my colleagues in Diageo. I say to them that with what we did in Diageo in Tanzania, when we chose to separate from a certain player and create our own footprint there, I said it's almost like you go to the lion's den to twist the tail of the lion. And I said no problem, except that you should know that it's a lion's tail you are twisting. If you do that and you are prepared, that's fine. I think with what has happened in Tanzania with Serengeti, we absolutely do expect that a competition would increase. We think that that's nice, that's okay, so long as, again, the playing field is level and everybody is abiding by the laws of the game. Early in the year, we had challenges with Forex in Southern Sudan, but hopefully, given the new dispensation, we would expect that there will be some improvement in that regard. And like I said before, we've had increases on fuel, electricity, and materials. But notwithstanding, I would like to say that management is very pleased with the results that we're sharing with you. We absolutely believe that this is a creditable performance. We had our board meeting yesterday, and all the directors were very pleased. Hopefully, when we share the results with you, you would know why they will be very pleased with what we delivered, in spite of all those challenges, which, from my perspective, again, speak to the underlying strength of the fundamentals of our brands, of our business across East Africa. So what have we done? A couple of things before I share the results with you. What have we done this year? We have actually strengthened our business by increasing investment in our brands, in our people, our route to market, our distribution, and most importantly for the future, our capital expenditure. So we did that consciously because we believe in the long-term sustainability of this business. We do not believe that the Alcohol Drinks Control Act in itself is sufficient for us to withdraw from investing for the long term. And in fact, on the act thing, in spite of the negative picture that on the surface it portrays. I have to say that after the initial consumer confidence that was shaken as a result of, even more importantly, as a result of the lack of clarity around what the act was about, when can I go to the bar to drink, when can I go to the bar. The good thing is that there's so much clarity around that. We're seeing consumers go back to the bar. Okay, people know their rights. I think there's less exploitation coming through from whoever was previously exploiting them. And therefore, that speaks to, again, the fact that the future is there, and we cannot absolutely withdraw from the business in Kenya. It's really our bread and butter. It's our flagship market. We believe very much in it. I cannot emphasize that enough. And I stand here to say that as a business, we are concerned about the Alcohol Act, but we do not see that as really significantly impacting over time the health of our business. So that said, this will be the headlines. Sales volume overall grew by 8%. And by the way, I got to say that this is our organic business. Organic meaning that we have not incorporated the results of SBL into this. I will show you in a second the consolidated group result that has the 8 months impact of SBL. Because obviously we took over the SBL, the Serengeti Breweries, I beg your pardon. We took over that business in November last year. So we've had 8 months of operations in that business. And obviously, statutorily, we are required to consolidate that result into our business. And I'll show you that in a second. But if you are doing, like for like, last year without SBL versus this year without SBL, this is what you get. And at operating level, again, which speaks to the health of the brand, we have grown our business by 17%, 17%. Okay? And the profit before interest and tax has grown again also by 6%. Peter, the Group Finance Director, will speak to some of these numbers when it comes, but I really want to highlight the fact that a couple of things there. You will see that we have actually, the growth in spend on our marketing actually outpaces the growth in volume. And again, it speaks to the fact that we are a business that is investing into the future. So it's a conscious effort, like I said before, to invest in our brands, because we believe in that. A lot of that is actually going into even the spirits brands, where we are coming off a very low base on a category that has the potential to transform our NSV performance, net sales value performance in this market, or across the region, I should say, in fact. So we've invested disproportionately in favor of spirits, because we believe that that's going to be the long-term NSV driver for our business. The other point I will raise out of this, aside from the operating profit that's growing 17%, is COGS. Now, when you have your NSV growing, and sales and NSV growing at about 6, 7, 8%, and COGS at 2%, I think very clearly it speaks to the quality of the focus that went into managing operating costs, in spite of those things I talked about, the increases in fuel and food prices and all of that, fuel especially, given the kind of operations that we run. A lot of work went into that, some of it having to do with what we call brand value re-engineering, in terms of how we do recipe substitution in a way that does not affect the product integrity, but actually helps us to minimize costs, as in the raw material costs. The team here have been absolutely wonderful in the way they've worked to hedge against inflation on some of the raw materials that we got, such that even well into the year, we were procuring a lot of materials as way below the market prices. I think that has been absolutely fantastic. Another key intervention that we've had on COGS, which is absolutely the reason that you've seen some of the growth in operating profit, has been in the way we have outsourced some of our logistics and warehousing materials, thereby enhancing productivity and service, but more importantly, also helping us to manage costs down. So on the whole, like I said, we are very pleased with the results. We have not come here to say that the Alcohol Drinks Control Act has made us to lose volume or lose profit versus last year. That's not our story. And in this result, like I said, Peter, the FD will do a little more justice to this, but clearly the beauty of this, and there's a slide that shows that, is that we actually have seen growth in our core brands. So your Tusker grew, Guinness grew. We saw growth in spirits, some of them high double digits, Johnny Walker in triple digits, again, off an absolute low base. But the reality of that is that it speaks to the headroom in terms of how we see the business and it growing. And because you are investors and shareholders, and I've been privileged to have read a number of articles in the last 2 weeks, 3 weeks, and it's okay because people can only write based on what they see. As insiders, we're not supposed to disclose all of the information to people, and people have been asking, so what's going to happen to EABL's profitability as a result of the Alcohol Drinks Control Act? What's going to happen to our dividend? What's going to happen to all of that? Hopefully we can answer some of those your questions today. The reality, if I leave you with one thing in this room, is to say that our business was never as strong as it is today, in spite of those challenges. And kudos to the quality of the people that we have, and obviously the strength of the brands and the support that we get from Diageo. I've talked about the NSV growth. I talked also about the fact that we invested in our brands. It's showing in the 15% growth. I've talked about the capital expenditure, okay, which actually has increased. If I tell you this now, in F10, for example, the capex investment in the business, capex as a capital expenditure, plant, machinery, what have you, was about 4.5 billion. Actually, about 35 million pounds would be what? About 4 billion, 4.5. Okay, this year we've done about 5.5 billion. So it's what? It's a new packaging line in Uganda to help us beat competition there. And absolutely, you'll see when Peter comes up that we have seen a turnaround in performance in Uganda. We put in a number of water storage facilities into the Kenya business here, especially given some of the challenges we're having with water availability and provision. We have completed the brewery in Moshi in the new business that we got. So we actually did invest in capital expenditure as we have done on the brands, again in service of the future that we are creating for EABL. And on talent and employee engagement, I think I spoke to that already about what we try to create. And it would delight you to know that our cash position is actually still very, very strong. Now, you could argue that given our investment focus over the next year, 2 years, what we're trying to do here is no secret that we've agreed with EABL that we've got to part ways. From our perspective, it's the best thing to ever happen to our business. So you would absolutely expect that over time we would actually repurchase the shares of EABL in KBL. We'll repurchase that. Just as we in parallel, we would have to dispose of our shares, the EABL shares in TBL, the 20% stake in TBL. Absolutely okay. So that would create some dynamic around cash and how we generate cash. But for a business that has not been leveraged, over the years, having this much cash, we're very, very comfortable that that we're able to navigate all those upcoming investments and transactions. So that was the organic performance without SBL. Like I said, we are required by law to consolidate SBL into our performance. I would say that we're still pleased with this, albeit kind of shaped differently than what you've seen with the normal business. But you'll see a 15% growth in volume, and that's easy to understand. So now we have PSL, Premier Serengeti Lager, which we didn't have last year. So that's why the inorganic thing could be a little deceptive, so to say. But just bear with me for a second and see where this is coming from. So if you add on the Serengeti Lager that we didn't have last year into this year's numbers with all of the other things we had, instead of the 8% I showed you on an organic basis without SBL, then you're looking at 15% sales volume. In terms of sales value, you're looking at 16%. Clearly, COGS is an area that we will have to deal with in SBL moving forward. We recognize that, no problem. And absolutely one of the reasons that we bought into that was that we could create the necessary synergies within the organization to enable us get some cost savings. You'll notice that our profit before interest and tax comes to flat, adding on the SBL thing. And we are not concerned about that. It's the first 8 months, first year. Our standards at Diageo EABL are much higher than most multinational companies, to be honest with you, let alone a private company that we're acquiring. So we have gone in there and said to ourselves that in the first year, we needed to integrate this business into our business in a way that we will upgrade capability there, put in systems and processes, create the platform for controls, for financial reporting to our standards, and so on and so forth. All of those, quite naturally, cost us quite some money, okay? But again, they are one-off costs related to integration, and maybe Peter will speak a little bit more to that. But if you see that the profit performance has declined from the plus 6% I showed on an organic basis to the flat result that you're getting on an inorganic basis, I'm just saying to you that a lot of that will be one-off costs that had to do with investment, including depreciation costs on the Moshi brewery that we built, and all of those things. So it's been a lot of investment on our part, and consciously so, I would believe rightly so as well. So, investment in integration, governance and compliance, A&P, and these were all, all that we did. Let me just give a little more context to, therefore, how we see SBL into EABL driving our future. From our perspective, we're here 9 months after. We still believe that, buying into Serengeti was absolutely the right thing to do. And the way to bring that home is to see the kind of results that our competitors drive in that market. It's a market that is growing, it's full of potential. Our brands are, from an equity standpoint, from a brand health standpoint, are by far the strongest. And so, why would we not be successful in that market? From November, when we bought a 51% equity, here's what we've done. So clearly now we've got a full portfolio of beer, and actually I must say of spirits as well, going into the market. Okay, we now have 3 breweries producing those brands in Tanzania, including the Moshi factory that was opened about, like I said, about a month, 2 months ago. Look at what this business is contributing to our group performance. So in the first year only, the first 6 months only, 7% of our volume came out of SBL, okay, and 9% came out of NSV, came out of SBL for their 8 months performance. So if I'm saying that we see this business as a really strong future growth driver for EABL, this is kind of a reason to believe. Okay, 8 months of performance in that business has almost done 10% of our NSV. And it's all about beer, no spirits in that kind of scale that we would like to have it. So I would expect that if we're standing here in a year's time, both in terms of volume, NSV, and profit, I think we'll be talking of a really good performance, a real transformation in the underpinning performance of our business coming from out of SBL. Like I said before, we spent a significant amount of money, significant, really material amount of money, focusing on processes, infrastructure, talent, health and safety, controls, compliance, and so on and so forth. Again, to make sure that, and I know I consciously repeat this, just because I do not want the investors to misread our results. So a lot of those costs will be the reason why you've seen an SPL that has diluted the group performance in F11. And in that regard, we see this as a one-off outturn. So moving forward, like I said before, for us it's still an accretive acquisition, still one that's going to drive our growth into the future. No regrets. In fact, if anything, we made the right decision. That's the performance, listing for all the brands. You can see, I said before that Johnny Walker grew, triple digits. We still saw growth in Tosca, albeit, coming from various markets. Kenya was, I think, about flat, slightly below last year. But we saw some really material increases in markets like Uganda, in the EABL markets, the international markets, which again helped to define the fact that we're a regional player and not just, a Kenyan business. So we think that this is a very good story to tell. And by the way, we got those volume performances in spite of the fact that we had a couple of price increases. So, and it's not, especially within the beverage business, not all the time that you increase your price, that you get this kind of volume performance. So we are encouraged by what we got. The marketing people would not want me to believe that these brands just, the volume just delivered itself. They always claim that it's because of the work they did. So they required me to acknowledge that here. I acknowledge you. These are the things that they did. They, you know all their stuff, Tusker Project Fame and Guinness Football Challenge and Tusker Innovation, Stand Tall, you are taller than the KICC building and all of that. No problem. They've done a good job for me. I'm pleased with them. Please put it on record. And I talked a lot about CapEx and the fact that we spent 5.5 billion shillings on CapEx in F11. And some of you might just want to know, what we spent on. That's it on your right. Some of them I spoke to already, and I think I won't need to go over them. And in terms of cost management, I think I spoke to that again, but I'm just bringing this home to tell you that even when volume was soft in Kenya, okay, with all of the challenges around the economy and all that, the strategy of the business was very clear. Drive as much top-line growth as you can by investing in the brands, okay? Manage midlines through cost management and all that. And then whatever you're saving in that and profit generated from the business, put it into investing into the future, since we all believe in the future of the business. So we've come out a year that has been challenging in Kenya, whereby we have still invested in the future in a way that has positioned us to continue to grow our business even into the future. And that's the story that we're telling investors today. On the people side, that's my friend here, the supply director, really getting really excited at the all-staff conference, which was good. And by the way, good to say that for the first time, because this is an annual event we have, for the first time we had all of the employees of Serengeti Breweries Ltd coming to Nairobi to join our 1,000 strong other EABL people. And I think we had about 1,500 thereabout in the room. It was amazing. It was really mind-blowing. And this was a time when people say, this is why I love EABL, this is why I love Diageo. So a lot of people have asked me also, with competition coming into Kenya, aren't you afraid you're going to lose your people? You know what I say to them, anyone who is going to leave, any place will leave. But I absolutely think that, engaging our people and keeping them to sign up to work for the company throughout their career is not just a function of what you pay to them. Of course, what you pay to them matters. We're all about reward and about money. There's really so much more around how you engage those employees. And there's nothing in my experience that really engages employees more than bringing all of them together, directors, junior staff, factory workers, lock everybody up in 3 days and just celebrate the good performances that you put through in the company, as well as, align on the future that you're planning for the company. That's what we do at our all-staff conferences. And they really, really do really excite our people and really inspire them. In terms of Force for Good, I talked about the fact that this is an area that is also very big for us. And, some of you are very familiar with our 4 pillars already. So the water of life, the skills for life, the environment piece, and as well as what we do with responsible drinking, okay? Water of life, this year now we provided water to about almost 700,000, 690,000, I think, yeah, that's it. We're very, very visible in terms of how we're supporting the Mao Forest, okay? In fact, I would like to say that we are really providing leadership in that respect. We're very big on the e-green agenda. Karura Forest, I think it's called, is another one that we've just taken on as an EABL pet project, and this is who we are. Skills for Life, scholarships to students, less privileged students who have the potential to really grow academically. We've done about 160 scholarships to date, and I think just about now we're recruiting another 20 or so, Brenda. So again, we're very clear on how we enrich our communities. Those 4 pillars are very big for us. Clearly, some of you will know that when the initiative of Kenyans for Kenya was launched recently, we played a very, very big part in that. Actually, we donated 10 million Kenyan shillings in support of that project because, again, we believe that we're not here just to sell and make profit, but actually to give back to the community. And lastly, responsible drinking, like I said, is an area that's very big for us as well. So in summary, we are delighted with the results of F11. Not only did we put in our best efforts to get to this result, because it was really hard work, but also it was a way for us to prove that we're a very resilient organization, very agile, and that we would not typically subdue to the challenges of the environment or that comes through regulation. So we're very delighted with that. We've seen also some big signs to, again, show that, the future is good. Our spirits business, for the second time, second year running now, has grown at a very high double digit. I remember the number we showed last year was something like 80%, okay? We're seeing a 56% growth on that. And the way I'm challenging the team is to say that we haven't hit the ceiling in terms of spirits performance. I mean, the way I always articulate it to my team is that today, spirits contribute about 10% of our NSV, net sales value. And you go to a market like South Africa, they sell so much spirits in that market, it does about 45, maybe 50% of our business in South Africa. That is significant. That speaks to the fact that we're still on a journey. And it's the reason when we say we have every reason to believe in the business, the future, is because, Alcohol Drinks Control Act or not, as I've said to people, how much of the headroom in spirits have we tapped? Can we transform our 10% contribution to 25%, see how much that means in terms of incremental NSV? We talked a lot about new geographies. We moved into Tanzania. We're making one or two other moves. How much is that going to add to our business? Who knows? Even within existing business, organic business, I say to people, if you have a distribution of 95%, means that there's a 5% of outlets where you are not. If you fill those outlets, that's not affected by Alcohol Drinks Control Act. That's so much business, so much volume for you. So yes, the regulations and around excise tax, alcohol act tend to slow us down. But the flip side of that is that we run an organization that is very agile and very keen to really grow business year on year, and therefore we do not necessarily get deterred by those things. We just move on and create new possibilities for the organization. Uganda is a particularly good story. We've turned around our business. This time last year, one of the questions that came from the floor was, what will happen to EABL if there was no Kenya? 90% of your this is from Kenya, 95% of your that is from Kenya. Our response to that last year was that we had challenges in Uganda. We knew the interventions we had to make. We were a couple of years behind in terms of investment. Okay, so we had periods of the year that were running out of capacity. And like I said before, so we've invested in the new packaging line that was commissioned last December. We can't even meet demand. Okay, costs have gone down because prior to that, practically all of their products were shipped from out of Kenya here into Uganda. But right now, they produce their own products, so costs have gone down. There are no logistics issues. We're beating the competition in the market, and we're making good money. Okay, so we've seen a turnaround in Uganda that really pleases us. Again, I've talked about some of the operational tools that we put in the marketplace. I've talked about the culture and the employee engagement things, and all of the things that I talked about, the conference and all of that, actually do impact on the results that we get when we go do value surveys with our people and asking them about how they feel about the organization. The results that we're getting are absolutely mind-blowing. Okay, mind-blowing in the context of Diageo globally. EABL is one of the best companies now in terms of how our employees feel about us. Okay, so and all of these things do matter. When you get into this very turbulent periods of regulations slowing you down or whatever it is, the brands are always the brands, but you can't count on anything, any asset bigger than your people. And if you're asking me to say in summary what has made a difference, that in spite of all of those challenges, you're able to report this result, it's a very easy answer. It's the people. Okay, the brands were the same 2 years ago, but it's our people that are driving this result. I cannot emphasize enough how grateful I am. I'm really privileged that I have this sort of people that I work with at EABL. And the SBL acquisition last November, clearly a lot of effort went into that. And I've said to you that the dilution of profit that you see is coming out of cost. And, I'd like to end on that note that, again, it just pleases me that I'm number one in this market now. And my good friend who runs the other business saw me the other day and said, Shane is just for a short while. And I told him, let's see. Actually, I borrowed that phrase from somebody else. So I told him, we'll wait and see. So, so the battle is on. It's a very healthy competition. But if you're clearly asking me as the CEO of EABL, where do you want EABL to be? On any measure, we've got to be number one. Thank you very much. On that note, I'll call on Peter to come and take us through the financials. Let's start with the future. Peter wants me to do the future before we do the financials. Let me talk about the future a bit. You want to hear about the future? Okay. We do not believe that the macroeconomic environment would necessarily worsen in sub-Saharan Africa. Okay. We know for a fact that the challenges around inflation, currency depreciation, and all that are things that we still need to worry about. And in fact, interest rates. The other day, I was told that some banks were changing their interest rates and increasing them and all of that. There are factors of life that we have to deal with. But the truth is that two reasons why, for the future, we believe in EABL. One is, if you look at the left in terms of what's happening with the economy. Of all the, whoever is forecasting anything, nobody ever forecast that GDP growth would go away in Africa. Whether it's 4% or 3%, 5%, we expect to see some growth. Okay, that in itself, we have the saying that to the extent that the GDP is growing, we're in a business that benefits from that. Okay, investor confidence, I think, will remain high relative to other parts of the world. Would be my offer. The EAC thing, I've said that we haven't seen the traction I would like, but we hope that moving forward, we will see a little more traction in that. And then there's the thing about the affluent middle class that is emerging. People now, who are working, young graduates, they're looking to get a mortgage for a house, they're looking to, get a loan to get a car and all that. I think all of that is good for the economy. But on our side, what does that mean for our business? How do we translate that into real, growth benefits for our business? I think the thing is that our brands are strong, but we expect them to be stronger just by way of our strategy around investment in brands. We've got a very strong balance sheet. I said to you before that it's not even sufficiently leveraged yet. Our cash position is very strong. Even when we do those transactions, we're a business that generates cash, so it's a reason to believe. I've talked a lot about our people. I've talked about Diageo, and we believe so much in governance and compliance. I mean, I'm judged by not just the standards in Kenya. When you say, but like I was saying, in Uganda, government comes to say nobody sells in sachet anymore. Next day we withdraw our products. Others continue, and people come to you and say, but other people are selling. The unfortunate thing is that I'm not judged. I'm not assessed in EABL by the bad things that other people do. Okay, I'm judged by the standards of Diageo worldwide, so I just have to absolutely comply. And it's the reason for you to know as shareholders that when you have your resources with us, they are as safe as, maybe actually safer than putting them under your pillow, because it depends on where you live as well. The things that we're going to deal with in the future to really guarantee the performance that we're wanting will be to leverage those growing economies I mentioned. I talked about spirits opportunity to really make that work for us, really transform that space of spirits. Because, in the past, the way we were working, the way we were, growing our spirits was completely at variance with our strategy to be a total adult beverage. Okay? And it wasn't that we're wrong or not. It was just that it wasn't the mindset. It was completely at variance. If we say that we want to be a total adult beverage, it means that we're going to be as good on spirits, maybe even better, as we are on beer. Okay? In the past, we were not. And to that extent, the contribution of spirits to our business has been actually constrained. It's really limited. The change, the transformation that we are seeing already, which I'm very pleased, is that, like I said, the last 2 years we've seen very high double-digit growth in spirits. And we need to continue to shift and really get into that spirit space to ensure that we really deliver on the total adult beverage strategy. And then the new markets, I can't say enough about that. Regulatory concerns, I've talked about it, I've called it overregulation. We would like to think that our Diageo marketing code, EABL marketing code, is not any less stringent than the Alcohol Drinks Control Act. It's just that it's a lot more practical and it's a lot more measurable than what we see. Competition is something we have to keep an eye on, and then operating costs to be the most celebrated, which was my first slide. I said what we want to be is the most celebrated business in East Africa. For the future, we're going to continue to focus on talent. Okay, so the whole space of people, safety, and all that I said before is key for us in EABL. We don't kid around when it comes to our people. It's big for us. Customer partnerships, the kind of arrangements, the work that we do with our customers will be such that they do not see themselves or us as suppliers. They see us in partnership. And then the piece around cost leadership is so big for us. We have work streams within the company dedicated to just ensuring that we beat down the cost of operations. Because we also recognize that there's only so much we can pass on to the consumer in terms of pricing. And that's what I need to also let you know, especially people in the media. Because at times when there's a price increase, we read all sorts of things. EABL, have just increased their prices. There are only two reasons we take our price increases, by the way. The one reason is that we kind of get burdened and overwhelmed by the cost increases that are coming through into our revenue stream. That is just not possible for as long as we owe it to the shareholders to deliver value. It's just not possible to absorb all of that. Will be one way, and the other way, other reason we'll do that is when we get these increases in excise tax. Okay, where again it's not planned into our value chain. Again, we have to pass that on. So bear in mind that that for us as an organization, we recognize that there's only so much we can pass to the consumer, and therefore we focus so much on cost optimization, cost leadership. Geographic expansion, we've talked about that many times. The route to market, we continue to really enhance our capability in that respect. I just talked about total adult beverage, how we balance our portfolio between beer and spirits. The community stuff, responsible drinking, and all of that. So we are confident that, in summary, personally, I feel that I was really proud and really free yesterday sharing these results with the board. Okay, because putting in context all that happened in our environment in last year, and last year for us, remember, was starting from mid of 2010 to mid of this year. And if you go back and think about the challenges, but we said to ourselves as a team that it's not in the character of EABL to come and announce that, by the way, this year we're declaring a negative growth on volume or NSV because X happened, Y happened. We were always convinced that irrespective of what we're dealing with, the resilience that would drive our business to the same space that it would have been had there not been any Alcohol Drinks Control Act, had there not been anything. We said that's who we were, that's what we want to be. So I'm pleased to say that we're here today to say that, so in spite of all of that, the company is a lot stronger today than it was last year. Thank you very much.
Good morning, everyone. Good morning again. Sorry, my voice is a bit, I'm a bit under the weather, but I'll make sure that I compensate that with what we are going to be announcing, which is very good results, as Sheni has said. What I'm going to do is to take you through the detail around the financial performance. I think Sheni has really done a good job on the strategic elements of the business, what's driving our value in the business, and also the major initiatives that we've had over the year. So what I'm going to do is really take you through the how the performance has come through from the business units, when you are reading our results, what you'll expect to see. I just wanted to start by saying what has driven our performance this year. When you look at our results, and we'll be putting this into the website later this morning, very solid results on the spirit side in Kenya. So despite all the regulatory concerns Sheni has said, really solid results. Partly because we've focused on spirits, as Sheni has said. However, also because tax regime on spirits has been very stable. And I'll be talking to the beer tax regime in a minute. The second aspect of our performance is a real turnaround of our Uganda business in the second half. When we announced our results at the end of half one, we were still facing a number of challenges. We've been talking about the turnaround in Uganda in the past few years, and this is the half that actually we've been able to see that rebound. Sheni has spoken to the cost management, and I'll add more detail in a minute. Clearly, we have acquired Serengeti. This needs to be seen in the context of both the future, but actually how we use our cash. And how that translates into return on equity for investors. The last point I wanted to speak to, which is very positive, is we've had a track record for managing our working capital. And you'll see that in a minute in the level of cash that we generate. We've kept control around our inventory despite inflation. We have invested more in funding for our distributors and our other partners, retailers, and therefore been able to grow our top line. And we have actually improved our payments to our suppliers and still been able to generate very good working capital results. And therefore that has fueled our ability to invest in CapEx. On the downside, we've seen a tough regulatory landscape, not just in Kenya, but also in other of our East African businesses. I should say that Sudan, although looking a lot more positive going forward, we did see some challenges in the year. On the beer side, higher excise taxes, a little bit of an unstable tax environment in Kenya, which is a bit unpredictable. We continue to engage the government in terms of understanding what the future is. However, we have seen in the past 14 months two big tax increases in Kenya. In the rest of the two countries, in Uganda has always been very stable around tax. And Tanzania, as you know, has the lowest tax from an excise perspective in the region. And we have been working with the East Africa community, talking to harmonizing the tax regimes across the region. As we came through to Q4, we've seen depressed economic fundamentals. We've seen, all of you are familiar with what has happened to the Kenya shilling and also the other shillings across the region with respect to the exchange rate to the dollar and also the sterling. Clearly, that has an impact on our business. We try to hedge as much as possible by relying a lot more on local raw materials. However, there's just so much that we can source from locally, and especially in the context of what we've seen with the weather patterns, the food situation, and therefore the availability of cereals. Clearly, inflation will continue to be a big matter as we go into F12, as we go into this year. However, we continue to put measures to manage that. And Sheni has spoken to the one-off integration cost that you see affecting our results as a result of investment in the newly acquired businesses in Tanzania. However, as Sheni has said, solid results. I won't go into a lot of detail on that from an organic perspective. I need to say here that organic results also exclude the impact of our share of associates. As you know, a 20% shareholding in Tanzania, we have not recognized our share of associates because we are, for accounting purposes, we are holding that investment as what we call available for sale, which means that we will be disposing of those shares in a while. And therefore, when you compare this year versus last year, it's not just the exclusion of the SBL business, it's also exclusion of the share of associates. and in organic, that this now includes everything, including the share of associates. Cost of sales, Sheni has spoken to the work that we have done in this area. When you're growing your cost at 2% against an 8% volume, that's really shows that on a per unit basis, yes, there's some scale economies there when you grow volume, but actually you can see some significant benefits there, which has resulted in some 2 points of gearing from a margin perspective on a gross margin basis. We've continued to rely on local cereals. As you know, as Mombi said, she's responsible for East Africa maltings. We continue to rely on local raw material, and that has really benefited our business whilst investing in the economy in terms of supporting farmers. We have made a step change on what we call OEE, which is operating efficiencies within all our sites across the region, all the way from the Uganda business, and we have one of the best run sites, which is the Kenya business here in Nairobi. When you compare it across the Diageo network, the Kenya site is one of the best in terms of operating efficiencies and actually cost delivery. As Sheni said, we've also been very, very strong around our financial management in terms of ensuring that we secure our key raw materials. We hedged a number of raw materials that were prone to increases given where the world prices of sugar, fuel, and that has benefited our business. Clearly, from Q4, we have seen escalation of those prices, and we continue to put more measures into the future. We've focused this year on stable tax regime. I've spoken to that. We've really enhanced our distribution of spirits, increased the availability of our spirits portfolio across all our channels, and grown, really focused on growing our premium and mainstream, what we call our premium and mainstream, because that's where we generate the highest value. And Sheni showed the double-digit growth around Johnny Walker, Smirnoff, and some of our premium brands, clearly resulting into improved operating margin, obviously together with cost reduction. In Uganda, last year when we at the half year, January, I think it was February, when we stood in front of you and reported the Uganda performance, it was a decline half year versus previous half year. You can see a significant increase in profit despite around flat volume, and the flat volume is related to the fact that spirits was a slight reduction because of the sachet ban in Uganda, but actually beer grew in Uganda in the second half. We gained market share in the second half. We repositioned our Bell brand in a new pack, just like we did our Tusker brand in Kenya. And as you can see, almost 70% growth, turnaround in terms of profit growth in Uganda, which is really significant. And I should say it is all across the P&L, all the way from the top line, but also going through the cost elements. So Uganda is a very big story for us. Great Lakes, which is predominantly sales to Southern Sudan and also to Rwanda, Burundi, and some of our duty-free markets, and also what we call our international, which is our export in the international markets. It has been a challenging year. Leading up to the referendum, which was completed in January, clearly an uncertain period for EABL. We saw the trading conditions were a little difficult because sometimes borders were closed, the scarcity of dollars that we saw. However, with the new nation being recognized, I think we believe that the future is more promising, and therefore we are more optimistic. I thought that I should spend just a few minutes just helping you understand the impact that obviously our Tanzania operation our participation in Tanzania has had on our business. As you know, in the previous years, we have participated through our 20% shareholding in TBL. We have derecognized that. We are not recognizing any share of profit this year. Previous year, it was 1.1 billion, so clearly a significant number, and that's why you saw a reduction from operating profit when you get to PBIT. That's what explains the 1.1 billion, because you're not comparing like with like. The shareholding in TBL, we are currently going through a disposal process, which will be undertaken through what we call an offer for sale through the Dar es Salaam Stock Exchange, and that will be completed shortly. And we expect, actually, this should be done by the end of October. And therefore, going forward, we should not be reporting that. However, we will be reporting our acquisition, the 51% acquisition of Serengeti. We spent 4.9 billion to acquire 51% stake in Serengeti. We funded that mostly from internally generated funds, other than some short-term elements, but mostly from internally generated funds. We have consolidated 8 months of Serengeti into the business, as Sheni has said, that contribution of Serengeti to our current turnover, which is what we call net sales value, is 4 billion shillings in NSV, which is really significant, and it's the 9% that Sheni spoke to. Just to explain some of the impact of the Serengeti business, we've spent 300 million, just about 300 million, in what we call integration costs around systems, processes, getting the standards to our business, and also interest cost of 200 million. We have spent 2 billion in capital expenditure just in Tanzania this year, mostly on completing the Moshi plant, which has now been opened and already producing both Tusker, but also PSL, what we call Serengeti Lager, premium Serengeti Lager, and also on crates and bottles, which we need for our business. So that now explains how those two businesses have, or those two operations have actually impacted our results for this year. We will be providing the detailed results on our website, so I don't expect you to read this, but on a net profit basis, on a consolidated level, net profit after tax, we've grown after incorporating SBL, but also the fact that we have not recognized share of associates, is still a credible performance of 2% growth above last year when we include the two elements in our results. And then I'll now go into, I'm sure, what most investors would be waiting for in terms of our dividends for this year. We believe, as Sheni has said, that this business is really well positioned for growth into next year, and despite some of the one-off elements that have come through from incorporating our Tanzania operations, from an accounting perspective, we believe that the future is still very bright. So we have made the decision, and the board has approved that we retain a dividend final payout of 625, bringing the total dividends to 875 per share on every share, which is the same as last year. So that's the dividend proposal that we have, and I'm sure that will be pleased. I'm hoping, we are hoping as management that will be pleasing to most investors. Just to conclude, I'll ask Sheni to come and do a summary, and then we'll take questions after that.
Okay. Go back. to conclude, from an organic standpoint, performance is exactly as shown. 8 on volume, 6 on NSV, 17% operating profit, 6% profit before interest and tax, without the two elements that Peter was speaking to, i.e. the elements of the share of associate profit that we got from our operations, our 20% participation in Tanzania last year, and then also without all of the integration costs that went into the new business that we acquired. If you stripped those out of our business, this is the result you see. Okay? We believe that this performance was driven by the fact that we saw some real growth in our brands. You saw the slide I showed that had all of the brand growths. We continue to invest in A&P. Actually, we invested in our A&P over and above the NSV growth. Okay? And then also in CapEx, I talked about the $5.5 billion that went into CapEx this year. Our focus on customer relationships, market development, the talent, I talked about our people, and the fact that SBL, even though hasn't really given us the kind of profit benefits that we would want, but from a top-line standpoint, has actually really bolstered our performance at top-line level. So it's been a really, like I said, really good performance from our perspective. Our initiatives around CSR continue to grow. And I think also, in terms of the future, what can you predict in this day and age? Virtually little or nothing. But the reality is that from our perspective, the economic outlook shouldn't get worse in our area. Politically, that's up in the air. It depends on what happens with all the upcoming elections. But you would also like to think that that should be balanced up by the new developments in Southern Sudan, which is a key market for us. You also want to consider that for us, again, we are very clear on our strategies. People are saying competition will come into this market. Yes, they will, but again, we are clear on our strategies is the answer to that. Fundamentals of the business are strong, gives us a lot of encouragement. We have not mortgaged our balance sheet to acquire the business in Serengeti. Like Peter said, we have actually financed that from the cash we generated from our business, plus a bit of a short-term facility. And there are not many companies that will say that they will pay that much money, about 5 billion shillings, just dipping into the wallet of the company. So we're really pleased with that. The future SBL acquisition has to come good for us. That's the space we are operating from. Again, I've talked about the opportunities with spirits, with new geographies. And we expect that, in spite of the fact that we haven't gotten the traction this last year on regional integration, with a lot of pressure coming through on the government to do something about that, and now people even talking about a Pan-African bloc, I think there will be a lot more pressure on our authorities to actually make that work for us, because it's good for business, it's good for the government, it's good for the economies. So to close, I really want to, before we get into the question and answers, I want to thank you for coming here. I want to let you know on behalf of management that the business is in very strong hands. I said to you that the board really acknowledged the performance yesterday. I am aware that Diageo has said that. Actually we had the president of Diageo here all week. Has been full of praises for this team on the performances that we delivered in the face of what we went through. I think the biggest news for me is to say that now that we have fully invested in the integration of SBL, the costs that have gone to dilute our performance at a group level are not costs that we are carrying into F12. And therefore, if I'm sitting here as a shareholder, I'll be saying, so what's going to happen with SBL? I think it's just going to be good news because the worst in terms of investment to bring it to our level is over. We're satisfied with the integration we've made. We are pleased with the controls and compliance in that environment. And of course, they're on a journey, a lot of work still going on. So I think that is a big sign for what will happen for EABL in the future. I think the flip side of that, which is also equally positive, certainly from my perspective, is the development that we expect in Kenya here. when eventually EABL pays for the 20% of SAB Miller stake in KBL, what does it give me? What does it give us as a team? Commercial freedom. Commercial freedom in the sense that we'll be able to create even a lot more innovation in this market than you have seen in a long time. Because clearly when you are in some relationship, you are bound by some agreements as to what you can do, what you cannot do. Okay? So we're going to look for cash. We're going to pay to buy back those shares. And then we're going to, by that, actually own our destiny at EABL. I am so excited about that. I'm so looking forward to that. So thank you for being here. We think that we've had an exciting year, and we're really well poised for even bigger growth into the future. So thank you very much. At this point in time, I'll hand over to Brenda, so Brenda can let us know. So thank you.
Thank you, Shane. As I said before, we will now take some questions. We would like at this point to ask for the questions to come from the business community and the investors. Thereafter, we will hold a separate session for the media. Thank you. We have some mics on the floor. If we have any questions, please raise your hands, and if possible, tell us where you're from. And another mic here.
Thank you, Shani. My name is Shani. We are receiving here on your performance, despite Mutudo laws. It's really encouraging, and you being now #1 highest capitalized company in the stock market is really encouraging. Okay, the dividend remains flat, but you have acquired a new baby. The only other issue is that you're not telling us whether we should be preparing ourselves for a rights issue for us to buy the 20% share. I don't know why you are being shy about that. So you better tell us in advance, because you obviously need some cash to do that. And really, this company is going places. And the other side of Mutudo issue is that he only attacked people drinking in a communal place. I think now you should be telling people now, take beer home, drink with your wife and your friends. So I don't think he has really disempowered you. He just changed the platform where we should be drinking beer. So we just should see it as a way of empowering women to participate in our
Thank you very much, my good friend Chris. Thank you. And I thank you also for the acknowledgement in relation to the performance of the company. Like I said, like you, we are pleased with that. In terms of, therefore, the KBL acquisition and what happens by way of rights or whatever, I think the reality is the two entities that make up KBL today are EABL and SAB Miller. So KBL as an organization is not a publicly listed company. And so you can't actually say that KBL as a company is, going on a rights issue. But I mean, clearly we monitor the situation at EABL from a cash perspective, okay, and we'll make the right decisions when we have to make those decisions. Regarding the off-trade, thing, it's really big for us. What I also need to say actually is that we're in the process of investing in a canning line, not least because a certain Titus Naikuni, if that name is familiar, he's always calling me to say that he doesn't have cans to sell on a certain aircraft. But we're going to get into cans. They're going to off-trade channels, supermarkets. If people choose to drink at home, that could be the right SKU, as we call it, the right package to get people to take beer home instead of going in bottles. But it's a good point, and it's something that, like you, we recognize. So thank you very much, Chris. And you're right on the rights issue. About whether we do rights or not, it's not something I would like to comment on now. There's a lot of work going on to say what is clear for us is that the ultimate outcome is that we're going to repurchase the 20% of SAB in KBL. So how we do that is still under a lot of consideration and work. And it's a publicly listed company, very transparent company. You're going to get to know what funding options we choose to go after. And in any case, we have our AGM coming up in a couple of months. I would believe that by then it would have been very clear, and it's something that we'll take to the shareholders as well. On Southern Sudan remains a key market for us. And in fact, to that extent, it's my good friend here that introduced himself as the managing director for EABL, has as top on his agenda priority in terms of, creating for us, the best route to market, the most optimal route to market in Sudan. So whether that comes out by way of a full-blown, greenfield, or we get into some joint venture, they are the sort of things that he's looking at. You realize that we have talked a lot about Southern Sudan in the past, but you would also, bear us witness that it's been a market that's been very uncertain politically. And clearly, like as a wise organization, we've got to be careful where we put our resources. There are people even who still suggest, if you belong to the pessimistic group, who still suggest that even though they've got independence now, there's still so much to deal with. Political rivalries between the tribes, lack of governance, lack of legal framework, and so on and so forth. However, if the question is, as EABL, are you interested in Southern Sudan as a market for the future? It's a no-brainer, okay? Are we going to just jump in there without looking before we leap? That's not going to be possible. We're going to look very well. We've gone far. We have a company registered there already. We have a piece of land that we have already secured, for potentially building a plant. A very, very, very good plot of land, actually. We have third-party distributors there. Our brands are very strong. We have the highest market share. So how much can I tell you about how important that market is to us? And therefore, it's very much on our radar. Regarding Ethiopia, it's kind of a more complex one. It says that the government of Ethiopia at some point will call for some auction around Meta, and then the other time you decide that you're not selling anymore. I think they've called for a new bid, and they have decided on their own volition to actually invite Diageo into that. We work hand in hand with Diageo. We're very close to Diageo's heart, and therefore I do not see any conflict of interest. But how that pans out, I think we'll know in the next couple of months. But there's been an invitation for a bid that was sent to Diageo. But we'll see how that pans out, like I said. Thank you.
Today, I think the silence means content. I will take it at that. We will ask for the investors to please, you're very welcome to stay behind and continue to have breakfast. And then we'll also reassemble ourselves with the media if there's a need for extra questions from the media before Mr. Adetu and Mr. Degwa have to go off for yet another presentation. Thank you very much for coming today.
Thank you, guys. Thank you.
Very thorough, that's why.
I think it's a tough environment. I just wanted to touch it.
When you acquire a business, in the first year you expect to spend some significant amount to actually be able to upgrade the capacity and capability of the business to our standard. As you know, that business was a privately owned business, and therefore the kind of processes and systems you have in place are not to the standard that we would expect. Clearly, it's a one-off. The interest cost is more related to the fact that we had to use bank debt to fund the capacity enhancement with the rebuilding of the Moshi plant, which will help us be able to deliver more sales in the new year. What we can say at this stage is what we expect the profitability of that business to be. What we do know, though, is that we will get a lot more synergies coming through on the cost side in particular. We'll use the EABL group capability in sourcing cereals, in sourcing other material, but also in the way that we manage the business overall from a skill set perspective, and we expect to benefit going forward.